Hi, everyone. So this is one section where we want to talk about the recognition and measurement of goodwill and the bargain purchase, right? The bargain purchase is also considered as negative goodwill. We start using the phrase capital reserve instead of calling it a bargain purchase or a negative goodwill. So in case there is a negative goodwill, while we calculate that, we would name it as a capital reserve and present it in the balance sheet, the group balance sheet, as a capital reserve. Okay, so let's start this journey in terms of how do we recognize and measure the goodwill, be it a positive goodwill or, of course, a capital reserve, which is a negative goodwill. All right. Now, we say goodwill is nothing else but whatever is the value of the business versus what you're paying against that. Okay. Right. Whatever is the value of the business versus what you're paying against that, the difference between the two is referred to as goodwill. Okay. So when you hear the terms called as consideration, we are referring to essentially the amount paid, maybe in form of shares, maybe in form of cash, maybe in form of a deferred consideration, or maybe in form of contingent consideration, right? And then you look at, of course, the value of that business, the net assets at their fair value. That's where you start looking at, of course, the goodwill coming into the picture. But importantly, to acquire a business, it is not necessary to have 100% acquisition, right? In a simple term, to achieve a business combination, it does not necessarily mean that you have to acquire 100% shares in that company, right? Till the time the stake is a controlling stake, right? Again, I'm still holding on with this discussion for Ind As 110, which is consolidated financial statements, right? But then till the time your equity stake in the other company, your decision making gives you a controlling stake that you're able to control the other business, right? It does not matter, which means that now whatever purchase consideration you're paying for that controlling stake, which could be 80%, which could be 60%, which could be 55%, or it could be any other value, right? And then you're saying that you also bring along that portion which is not owned by you. Okay. So take the amount of what you paid for 80, 60, 55, whatever it is, plus also take into consideration that amount which is, or that proportion of the business or the proportion of the shares which are not owned by you. Okay. Take them together and compare it with the value of the business. That will give you again the value of goodwill. Okay. There's also a reference that you see, something called as a previously held equity interest at fair value. We shall be discussing that. This is something which is to do with business combinations achieved in stages, right? You may already have 10% stake in a business and now you acquire another 80%. That makes it 90%, right? With the 10%, you do not have the control, but with 90%, you have the control. So how do you calculate, for example, goodwill in those scenarios? Okay, so we bring all these, coverage, and there are different ways, of course, these controlling stakes may be acquired. In all these cases, the goodwill needs to be calculated, right? So we'll start step by step and try to obviously achieve that particular objective. Okay, so we're simply saying that your goodwill is nothing else but whatever is the amount paid for the stake that you are buying or the stake that you did not buy minus the value of the business results in the goodwill, of course, right? We have already discussed that any related costs are charged to the statement of profit or loss, and any issue cost for the debt equity would be dealt with as per the the accounting under Ind As 32 or Ind As 109 as the case may be. All right. So when I say I'm looking at the calculation of goodwill, right? We are simply talking about the understanding that, and we did that, of course, where we said that there is a 100% shares acquired in a business, right? Where we said that you're paying 100 crore rupees for something, and it's for a business, and the value of the assets, if I just quickly take you there, 100 crores was my purchase consideration, and the net assets were, let's say 90 crores, and the liabilities were 30 crores, effectively becoming 60 crores. And then we also had the fair value differences there, where we say it is another 15 crores, right? Subject to any deferred tax consequences, we are effectively saying that the goodwill calculation is done at 25 crores, right? That's a kind of calculation we did. Now what I would like to do is, together with you, is basically try to explain that what if you don't acquire 100% stake in a business, right? If you do not acquire the 100% stake in a business, then how does the accounting flow? How do you calculate goodwill in those cases? We are saying now, in the similar situation, right? So let's bring this perspective that the assets in the other company are worth 90 crores. Okay. Liabilities are worth 30 crores. So this is the carrying value. All right. And then we are saying the fair value of assets is indeed 120 crores. Okay. And the fair value of liability is, let's say, 45 crores. Okay. Amount paid, let's say, for 80% shares. Okay. The amount paid for 80% shares is, let's say, 100 crores here. Okay. And as of now, we are saying ignore taxes, ignore the consequences of deferred taxes, just for the sake of argument, right? We'll bring the taxation part also in a minute. Okay. Now, when I look at this scenario, we are saying that my purchase consideration is indeed 100 crores. So I'll take it from here. Okay. And then I'm saying the net assets, wherein I talk about the assets at 90 less liabilities at 30, which makes it 60. Plus we say fair value difference, which is another 30 minus 15 makes it, of course, 15 in the outer column, which makes it 75, right? Now, importantly, you want to remember that you're paying 100 for 80% stake. You're paying this 100 crores for the 80% stake, right? But then this 75 represents 100% of the business value. All right. So it does not make sense to calculate goodwill by simply deducting 75 from 100. you would rather adjust this 75 for that portion of that business that you do not, you did not acquire, right? Something referred to as a non-controlling interest or NCI, okay? Which is, of course, 20% value of the net assets. Whatever are the net assets, including the fair value differences, right? You take 20% of that, which means that you are effectively paying 100 crores for something worth 60, thereby measuring your goodwill at 40 crore rupees there. Okay. And that is how you start building or incorporating the adjustment for the non-controlling interest. Okay. When you do not have 100% stake in another business, but it is a controlling stake nonetheless. Okay. Your examination would always clarify, and importantly, even if it does not clarify, but the stake is more than 50%, you may assume that this is indeed an example of a controlling stake. So you don't have to worry beyond a point. Okay. So when you look at this entire scenario, the goodwill is calculated at 40 crore rupees. Okay. The important point that you want to take into consideration here, that whatever was the value of the net assets, 75 crores in this case, you are taking a proportionate amount of those net assets, right? We simply took 20% value of the net assets. So this is one way to calculate the non-controlling interest. Okay. Your examination would normally specify. And even if they don't do, then by default, you can use this as a parameter of calculation of the non-controlling interest. There's yet another parameter. We'll be discussing that in some time. Okay. But importantly, in this case, if I bring the deferred tax calculation also, let's assume the tax rate is 20%, right? Thankfully, nothing much changes. I'm still using the similar format where I'm saying the purchase consideration is 100 crores. Less net assets, wherein I'm saying assets book value is 90. Liabilities is 30, brings 60. And then we're looking at fair value differences, which is 15. But on this 15, there is also a deferred tax liability which arises now, of course, at the rate of 20%. So it means that when I'm looking at this calculation, that gives me 72. Okay. Now, importantly, on this 72, I need to calculate my NCI of the remaining 20%, which becomes, of course, 14.4. Okay. When I take it to the outer column, effectively, we are saying that the amount that you're supposed to, that you're paying, which is 100 crore rupees, you're paying against the value of, let's say, 57.60, thereby making your goodwill amount coming at, right? $42.40, right? So the fundamental difference that you see is that when there is a deferred tax consequence, even the NCI is impacted, because the base or the base value to use for the NCI is indeed the net assets taking the impact of those fair value adjustments and the corresponding deferred tax consequences also, right? And that is where you start looking at the relevance of calculation of the non-controlling interest, for example, under the proportionate method, right? Always take the net assets, including the deferred tax consequences. This is what you want to remember at all times there. Okay. At the same time, if you look at the other scenario, right? You start talking about, the measurement of goodwill, or let's say the capital reserve, which is bargain purchase basically. So this is something that we are trying to kind of pick up. It says that the goodwill is the difference between whatever is the value of the business versus the fair value, together with the fair value of separate net assets. And you would take into consideration, take into effect the fair value of the purchase consideration and the amount of the non-controlling interest, and you deduct from those the overall fair value of the net assets on the date of acquisition. This is all done on the date of acquisition, right? Which means what? You need to determine the fair value of net assets on the acquisition date in practical life. Okay, your examination gives those values, so don't have to worry about it. Okay, but importantly, you need to take into consideration all those identifiable assets and liabilities. Okay, and that is where it would either result into a positive goodwill or a capital reserve, right? Now, a capital reserve signifies what? You're paying less than the company's worth. You're paying less than the company's worth. Does it happen often? The answer is no. This is something which happens rarely. But of course, there's a possibility that it can happen, right? So what do? We are saying that if it is a goodwill, you recognize that as a separate intangible asset, right? But if it were a capital reserve, you show it as a part of reserves, of course, within the equity. Okay, that also reminds me here that in case you are doing two different acquisitions, so let's say there's a company XY that acquired A as well as B, herein there's a positive goodwill of 100 crores and there is a capital reserve of 40 crores. You are not allowed to offset these amounts. Okay, so this 100 would be shown separately as an intangible asset, as goodwill, and this 40 will be shown separately as a reserve, both appearing in the balance sheet of the company XY as an acquirer. Okay, that's what you want to remember at all times. Non-controlling interest, now we want to kind of spend a little time on that further. We have discussed this format already. Okay, that the method of calculation of NCI could be on the basis of a proportion of the entities or the subsidiaries or the acquirees identifiable net assets. So whatever is the value, including the deferred tax consequences, you take a proportionate value of that, right? And tomorrow, if there is any goodwill impairment, that would not be chargeable to NCI, because this goodwill is referred to as a partial goodwill, for example, and it only relates to the parent. Okay, it only relates to the parent, right? I would want you to go back and look at the discussions that we had under Ind As 36, which is impairment of assets. That is where you would see how is the impairment loss allocated in case, for example, there is a subsidiary being acquired, right? In terms of the allocation of the loss between the parent and the non-controlling interest. Okay. The other method, which is used for calculation of the, the NCI is referred to as a fair value. And under this method, the goodwill that is calculated is also called as a full goodwill, right? Or a group's goodwill, right? And any losses, any impairment losses, if they arise, if the goodwill is impaired, the loss is also, spread between the parent as well as the non-controlling interest, between the acquirer, right, to the extent of his shareholding, let's say 80%, for example, and also to the other portion which he has not acquired, the 20%, which is referred to as the non-controlling interest. Okay. Importantly, you may have the NCI calculated for one entity. When you acquire that entity, you might want to use a proportionate share method. For some other acquisition, you might want to calculate NCI on the basis of fair value. All right, that is something that you want to remember. Of course, we discussed that in impairment any which ways, that a goodwill which is calculated, it is not amortized. It can only be tested for impairment. All right, that is something that you want to consider here at this point in time. Right. Let's try to understand this. I mean, this could be a little conceptual, but it would be important to follow what we are discussing here. So we said that using the similar example, there was a purchase consideration of 100 crores. Okay. And then we said that the net assets, they were calculated. Asset at a book value of 90. Liabilities at a value of 30, giving 60 thereby. And then we looked at fair value differences, which were 15, making it 75. And then we said there's also a deferred tax liability at the rate of 20% on this 15, of course. We said 3, and that becomes 72, right? Let's keep it even further. Now, on this 72, we said that under the proportion, the NCI is taken at 20% because you only acquired 80% shares in the acquiring. All right. So the NCI we calculated at 14.40, and effectively we said that we are saying we are paying 100 for something worth 57.6. That results into a goodwill of 42.40. Right. This is something we just did. And here the NCI was calculated using a proportionate method or proportion of net assets method. Right. However, if I say that the NCI's fair value for example, is calculated at 20 crores. Okay. My question in my examination provides me that information. It says that calculate your goodwill using fair value of the NCI. Then what do? We simply replace this 14.4 with 20 crores. So of course, the purchase consideration remains same. Okay. 100 crores. Net assets are 90. So I'm taking the corresponding values around. Let's take this 100 even further. This is 60. And then we had fair value differences of 15, making it 75. Deferred tax consequences of 3, making it 72. And my NCI is 20 now. So NCI at fair value, which is 20, thereby suggesting that I'm paying 100. The way I would want you to interpret is we are paying 100 crores for something worth 52, which means that the goodwill here is 48 crores, right? It simply suggests, it simply conveys that basis the accounting policy choice, basis the choice that I make in and valuing my non-controlling interest, my goodwill calculation can differ. That's a simple calculation, or that's a simple explanation of the same, right? And it's up to you whether you want to use you want to measure the NCI using the proportionate assets method, or you want to use it for, let's say, at the fair value. Okay, let's have a look at this question now, right? This is something we have done, by the way, directly or indirectly, but we want to do it together. It says Pluto Limited decides to acquire 75% of Saturn at a valuation of 200 crores in exchange of cash of 175. Okay, the fair value of the NCI is provided at 60 crore rupees. Calculate the value of goodwill under the permissible method of measuring the NCI. Ignore the deferred taxes. All right. Now, effectively, we are saying that you are paying the purchase consideration is $175. Okay. And then we are saying that the value of the business is given at 200, right? But out of that 200, you did not acquire 25%, which means that you are paying 175 for something worth 150, right? So this is the goodwill calculated under proportion of net assets, right? This NCI is nothing else but 25% of the net assets, hence proportion of net assets method. On the other hand, we may argue the purchase consideration is 175, net assets are 200, and the fair value of the NCI is 60, which means that my goodwill is rather 35, right? This is partial goodwill. This is full goodwill, okay? Or this is parent's goodwill, and that is the group's goodwill there. It can be done like that, right? Well, it would be a bonus if you get a similar question, in your examination. No deferred taxes, the value is given, and you just need to kind of plug in the numbers to calculate these amounts, right? We've done this already, so we're talking about, of course, the accounting consequences. The goodwill is 35 crores under the fair value, and then the goodwill is, of course, 25 crores under the proportionate proportion of net assets, right? Bargain purchase, as you said, it's a negative goodwill. It's desirable to use the term capital reserve. And importantly, that could be, it's more of a concept which is available, and we should be, comfortable knowing that normally you don't expect to get a benefit when you acquire a business. You can't get it for a bargain value, but sometimes it can happen because there is a forced sale. Somebody is on the verge of a bankruptcy, or there could be a regulatory requirement. There could be a compulsion to sell the business, and they're not able to find or identify the right value of the business. Somebody is willing to do that, and of course the business or a bargain purchase or a capital reserve can arise, right? But the standard emphasizes that the acquirer should reassess whether all the assets and the liabilities have been correctly identified. Okay, and in case there is still a capital reserve, that gain should be recognized in the other comprehensive income and parked as a capital reserve. Okay, and this is purely the acquirer's reserve, not available to the non-controlling interest. Just to highlight, this is purely from the acquirer side any which way. So there is no implication as far as the NCI shareholder is concerned. All right, let's have a look at this scenario. It says that on 1st of April 18, Jupiter acquired 85% equity in Neptune by paying 300 crore rupees. The former owners of Neptune did not have sufficient time to find potential buyers, as they were asked to dispose of their investment by a specified date, and accordingly, the valuation was not appropriately done by the owners. Right? Eventually, the identifiable net assets were valued at 400 crore rupees, and the fair value of the NCI was measured at 84 crore rupees. Now, the question is, how do you recognize the above, transaction? How do you deal with, or how you account for the above transaction there? So, if you look at all these numbers, we're talking about the purchase consideration, which is 300. Okay, the net assets are 400, but the NCI is measured at 84, okay, which gives us 314. So effectively, we are saying we are paying 300 for something which is worth 14. That makes this 14 crores as a capital reserve. Okay. So essentially, when you look at this entire, context, then we are saying, of course, that let me go back to the calculations if we've done it correctly. Yeah, it's 316. My apologies. Right, so this is where it's got. So the 16 crore rupees becomes the, the gain on purchase or gain on the bargain purchase, and accordingly, you need to recognize that as a part of your capital reserve. Let's look at the formal solution. It says, in this case, the amount of Neptune Limited's identifiable asset, which is 400 crores, exceed the fair value of the consideration plus the value of the NCI, right, which is a total of 380 crore rupees, right? In this case, Jupiter should review its procedures, whether they have captured every, asset, liabilities, etc., in the right manner, right? In case they agree or they understand that these all measures were appropriately taken, so this 16 crores would be recognized as a capital reserve and should report it through the OCI, right? That is something which is the explanation that we wanted to give on this part, right? This is something which is also reflected, that the gain on bargain purchase of 85% interest is calculated at 16 crore, which is recognized in OCI, right? And in case, although it is not available as a information indication, but in case you want to measure the NCI on the basis of proportionate share of identified net assets, then essentially the 15% of 400 crores would be 60, right? And then you're talking about, of course, you're paying 300 for something worth 400 subject to 60, and that would make your capital reserve calculated at 40 instead of 16 in that case, right? It's just about the calculation changes, but fundamentally the measurement criteria would remain the same in this case, right? Now, this particular section, we want to talk about where we discuss that, on the date of acquisition, when you are acquiring control, ideally speaking, you should be talking about the fair value of all the assets and liabilities, right? Now, how feasible is that for the acquirer to do that exercise, right? Especially when you're talking about one large company acquiring another large company, right? It is practically impossible to do those calculations in a limited time frame. So the standard acknowledges that, the standard recognizes that, and it says that you may do provisional locations as well, right? So we're saying that if the initial accounting is incomplete by end of the reporting period in which the combination has occurred, then you can report it through the provisional amount, which simply means that your goodwill calculation is also provisional. Okay, so effectively we are saying that the measurement period is allowed wherein you are allowed to adjust those provisional amounts as you recognize under the business combination, right? And at the earliest, when you have received all the information, right, then you would be naturally able to incorporate that information, right? I mean, the accounting for the acquisition cannot stop. That's the whole message, right? You cannot wait for days to happen wherein you would start recognizing the business combination, because it can happen that during the interim reporting periods, these numbers need to be reported, right, while your valuations are pending. And there's a reason why a provisional allocation is a workaround solution, right? So the standard suggests that you are allowed to use some provisional values, and this closure of these values has to be done within 1 year from the date of acquisition, right? That is something which is the expectation. Otherwise it would result into a possible qualification, or it could result into errors for that matter, right? Now, in case you're doing that provisional allocation, that would result into a retrospective restatement. You're practically going back and bringing the changes in those calculation of goodwill and the relevant numbers on the comparative perspectives. Okay, so that's where you start looking at the significance of that. And after that measurement period has ended, any changes could be only done as if it were actually considered as an error. So any which ways you go back on the retrospective, statements from from recognition of an error in the books of accounts, right? Something that you would want to understand on a conceptual basis once again. All right, let's have a look at this particular scenario. We may be able to appreciate it better in terms of what does it mean. It says that on 1st of April 17, A Limited acquired 100% equity stake in B Limited for a cash consideration of 30 crore rupees. A Limited completed the purchase price allocation, or a PPA, and recorded net assets of 20 crore rupees. B Limited has significant carry forward losses on which deferred tax asset was not recorded due to the lack of convincing evidence on the acquisition date. However, on 31st of March 18, B won a significant contract which is expected to generate enough taxable income to recoup the carry forward losses, and accordingly the deferred tax asset was recorded on the losses as on 31st of March 18. Now, importantly, this is all coming through the income taxes accounting standard. Ind As 12, you would recollect, right? The question here says you're required to determine whether the aforesaid losses can be adjusted with the goodwill recorded based on the preliminary price allocation, right? Now, you would remember that there is a provisional allocation done on 1st of April 17. And then you're talking about, of course, 1 year time frame, which is up to 31st of March 18. So you can actually do those adjustments in the in the financial statements for that basis, right? But in this scenario, what you need to understand is that the change in the information has happened because there is there's a new new transaction that has taken place, right? There's a new transaction that has taken place, which simply suggests that if I look at 31st of March 18, and this was my date of acquisition, right? On this date, there is a new contract that has been won, right? Which never was into existence on this initial date itself, right? Had it been a rediscovery of those calculation of possible gains in the future, and accordingly the recognition of deferred tax asset could have been done for the initial date, then it could have been adjusted. But this information only arose with a new contract being won at a later point in time. So this has no significance as far as the calculation of the goodwill on the date of acquisition is concerned. That's something that you want to, of course, consider here, which means that this DTA would not be considered as far as going back to the date of acquisition is concerned and changing the amount of goodwill in the available situation. All right, that's something that you wanted to, of course, bring along. Let's have a look at some smaller scenarios. It says that there's scenario one, there's a new information on the fair value of an acquired loan. It says 1st of April 18, Dhan Limited acquires Lakshmi Limited in a business combination. Both are registered NBFCs. As a part of the business valuation, the loan to AB is recognized at its provisionally determined fair value. In June 18, which is 3 months later, Dhan Limited receives AB's financial statements for 31st of March 18, which indicates significant decrease in borrowers AB's profit after tax. Basis that the fair value of loan to AB is considered to be less than the amount earlier recognized. The second scenario says that there's a change in the value from an event occurring during the measurement period. So it says that on 1st of April 18, Dhan Limited acquired Lakshmi in the business combination. Both are registered NBFC companies. And as a part of the valuation, the loan is recognized as a provisional value. So it's a similar paragraph like the previous scenario. In June 18, however, Dhan Limited receives information that AB has lost its major product dealership earlier that month, and that is likely to have significant negative impact. Now, essentially, in the first scenario, you would talk about it's an information which was applicable even for the loan that existed on the date of acquisition, right? But as far as this scenario is concerned, this is purely a remeasurement. It's purely a remeasurement, and there is no such changes which are required to be made, and the entity is not allowed to go back and make those changes in its calculation of goodwill, etc. Right? In the first scenario, you will make an adjustment, and accordingly, the goodwill value will change. But on the other scenario, you are simply adding it to the information which is a subsequent event, not something which was related to the information that existed on the date of acquisition of that business there. All right. Let's have a look at this scenario. It says that on 31st of January 19, Sean acquired Michael in a business combination. Early 2019 January, that is few days prior to the date of acquisition, a large customer of Michael claimed that certain amounts were due. Sean evaluated the dispute was there and concluded that Michael was responsible for some of the breach of some of the important clauses, and hence liable to be claimed, right? Liable to the claim made by the customer. Based on the evaluation, Sean Limited recognized 5 crore rupees towards its liability, which is the best estimate of the fair value at the date of acquisition. In September 19, within the 1 year's time frame, the customer presents additional disclosure information, and the fair value of the liability undergoes a change. All right. It says that Sean Limited continues to receive and evaluate information related to the claim. It doesn't change till February 20, which is up to the 1 year from the acquisition date. When it concludes that the fair value of the liability is indeed 9.5 crores, Sean Limited determines that the amount that would have been recognized is in fact 11 crore rupees. The question is, how should the adjustment to provisional amounts be made during and after the measurement period, right? So what started with at 5 crores, all right, eventually came to 10 crores and then was measured at 9.5 crores, and post the the measurement period, it arrives at 11 crores, right? That's something which is the information available. What you need to remember here is that the initial part of 5 crores is considered as the fair value on the date of acquisition, although it is a provisional value. Okay. When this additional information is provided, which makes it 10 crore rupees, it simply would be going back to the part of your changes in the acquisition value, and accordingly, the goodwill value will change as well, right? And accordingly, all those facts, etc., would be disclosed with respect to what was the original value and what was the change that happened during the period. Anything that happens at a later point in time, which is, for example, in the month of February, right? That change does not change in your acquisition accounting, but it would simply be going as a change in that contingent liability, and all those changes would be reported simply through the statement of profit or loss. So effectively, what you were showing as 10 crore rupees would now be shown at 11 crores, and this amount of 1 crore becomes your expense there. All right. Now, this is a large section that we discussed. Of course, the entire conversation is very critical from an examination standpoint, from the coverage of questions that we would be, looking at, as a part of the standard on the group account, right? So to revisit this section, we are saying, look at the goodwill, which is nothing else what you're paying versus what you are getting back. And then there could be a positive goodwill, show it separately as an intangible asset, or there could be a capital reserve, show it as a part of your equity, of course. You are allowed to do a provisional measurement up to 1 year of time. And in case there is, a change expected, then you do a retrospective adjustment. You change your value of goodwill as well, right? The NCI, or the non-controlling interest, we mentioned that there are two ways. Either you show it at a fair value or show it as per the proportion of net assets there, right? You're allowed to use one of the methods or either of the methods in each of these business combinations. For one business, you might want to use a fair value method. For some other business, you might want to use, let's say, a proportion of net assets. That is all permissible. All right. Thank you very much.